In this video, I am going to do a breakdown of the $1 million portfolio. Set it and forget it with this 3-fund strategy, and more importantly, I'm going to show you why most people overcomplicate their path to wealth. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this honest, valuable information for free. Now let's continue. In the next few minutes, I am going to show you how to move away from the constant noise of the stock market and move toward a definitive $1 million portfolio strategy that actually lets you sleep at night. Most people approach investing like a high-stakes game of poker, constantly checking their phones, worrying about the next market crash, or chasing the latest speculative trend. But the truth is that the wealthiest individuals often use a remarkably simple approach. We are diving deep into the 3-fund strategy, a method designed for those who want to build serious wealth without making it a second full-time job. This is about total stock market index fund investing, and it is the closest thing to a set it and forget it system that exists in the financial world today. If you have ever felt overwhelmed by the thousands of stocks and bonds available to you, this conversation is going to change your entire perspective on how money is grown over the long term. To truly master this and reach that 7-figure milestone, we first need to understand the fundamental problem with traditional investing. Most retail investors suffer from what we call diversification drag, or conversely, extreme concentration risk. They either own too many random things they don't understand, or they bet everything on 1 or 2 tech stocks. The 3-fund strategy solves this by capturing the entire growth of the global economy. Instead of trying to find the needle in the haystack, we are simply buying the whole haystack. This isn't just a collection of assets. It is a philosophy rooted in low-cost, broad market exposure that leverages the power of compound interest while minimizing the fees that eat away at your returns. Think of your portfolio like a high-performance engine. For an engine to run for decades without breaking down, it needs a specific balance of components. In our $1 million framework, those components are domestic stocks, international stocks, and high-quality bonds. When you combine these three, you create a self-correcting mechanism that thrives in different economic climates. This is transformation-based investing. We are moving you from a gambler mindset to an owner mindset. You are no longer betting on whether a specific company has a good quarter. You are owning the productive capacity of the entire world. Let's break down the first and most vital pillar, the total domestic stock market index. This is usually represented by a fund that tracks the performance of every publicly traded company in your home country. For most viewers, this is the US market. By holding a total market fund, you aren't just betting on the giants like Apple or Microsoft. You are also capturing the growth of the mid-sized companies and the small-cap innovators that might become the giants of tomorrow. The beauty here is the internal turnover. As companies fail, they drop out of the index, and as they succeed, they climb higher. The index does the pruning for you automatically. To succeed at this, you have to realize that you don't need to pick the winners if you own all the players. This removes the psychological burden of wondering if you should sell your winners or hold your losers. However, focusing only on your home country creates a blind spot. That leads us to our second pillar, the total international stock market index. The global economy is a shifting landscape. There are decades where domestic markets lead the way, and there are decades where international markets, developed and emerging, outperform significantly. By adding an international component, you are essentially buying insurance against a localized economic downturn. You are participating in the growth of electronics in Asia, manufacturing in Europe, and raw materials in South America. This layer of the strategy ensures that your million-dollar goal isn't tied to the fate of a single currency or a single government's policy. It provides a smoothing effect on your returns, which is crucial for staying the course when things get volatile. Now, many people in their 30s or 40s think they can skip the third pillar, but that is often a mistake that leads to emotional selling. The third pillar is a total bond market index fund. Bonds are often misunderstood as boring, but in a set-it-and-forget-it portfolio, bonds act as the ballast on a ship. When the stock market takes a dive, bonds typically hold their value or even increase in price as investors seek safety. This prevents your portfolio from dropping so low that you panic and sell at the bottom. The goal of the bond portion isn't to make you rich. It's to keep you rich by providing liquidity and stability. It allows you to rebalance, which is the secret sauce of this entire process. To see real transformation in your net worth, you have to understand the mechanics of rebalancing. Imagine you decide on an allocation of 60% domestic stocks, 20% international stocks, and 20% bonds. If the stock market has a massive year, your stocks might grow to represent 80% of your total wealth. At that point, your engine is out of alignment and you are taking on too much risk. By selling a bit of what has gone up and buying more of what has stayed flat or gone down, your bonds and international stocks, you are forced to follow the golden rule of investing: buy low and sell high. This happens naturally within the three-fund framework without you having to guess when the highs and lows are actually occurring. One of the biggest hurdles to reaching $1 million isn't the market itself. It's the hidden leak of expense ratios and management fees. Many actively managed mutual funds charge upwards of 1% or more. That might sound small, but over 30 years, that single percent can take hundreds of thousands of dollars out of your pocket. The three-fund strategy utilizes low-cost index funds, where fees are often near zero. We're talking about the difference between paying $10 a year for every $10,000 invested versus paying $100 or more. By keeping your costs at the absolute minimum, you ensure that the vast majority of market returns stay in your account to compound. This is how a modest monthly contribution transforms into a massive retirement nest egg. The simplicity of this approach is actually its greatest strength, but it requires a shift in behavior. You have to be okay with being average. But here is the secret. In the world of investing, average market returns actually place you ahead of about 90% of professional money managers over a 15-year period. Most people fail because they try to beat the market and end up underperforming due to bad timing and high fees. By accepting the market return through these three funds, you are mathematically tilting the scales in your favor. Let's talk about the actual execution. This is where the set-it-and-forget-it aspect comes into play. You can automate your contributions so that every time you get paid, a set amount goes into these three funds. This is called dollar-cost averaging. You buy more shares when prices are low and fewer shares when prices are high. Over time, your average cost per share becomes very competitive. You don't need to watch the news. You don't need to follow financial gurus. You just need to keep the machine running. As you move through different stages of life, the only thing that really changes is the ratio between these three funds. When you are young, you might lean heavily into the stock portions for maximum growth. As you approach the day you want to live off your portfolio, you gradually increase the bond portion to protect what you've built. It is a sliding scale that evolves with you. This strategy is evergreen because it is based on the reality of how capitalism works. As long as companies strive to make a profit and the global economy grows, this portfolio will capture that value. The transition from a cluttered, stressful portfolio to a clean, three-fund strategy is often a moment of immense relief for investors. You stop worrying about whether you bought the right hot stock and start focusing on your savings rate and your time in the market. Those are the two factors you can actually control. Wealth isn't built by finding a shortcut. It's built by staying disciplined with a proven process. You are building a fortress that is designed to withstand inflation, recessions, and market bubbles. The real beauty of the million-dollar portfolio is the freedom it provides. Money is just a tool, and a set-it-and-forget-it strategy gives you back your most valuable asset, time. Instead of spending your weekends analyzing balance sheets, you can spend them with your family, traveling, or working on a passion project, knowing that your capital is working hard for you in the background. You have moved from being a servant to your money to being a master of your financial destiny. We have covered a lot today, from the necessity of total market exposure to the importance of keeping fees low and the power of automated rebalancing. The core takeaway is that complexity is often the enemy of execution. By narrowing your focus to these three broad pillars, domestic equity, international equity, and total market bonds, you create a robust, diversified, and highly efficient wealth-building machine. You don't need a complicated algorithm or a high-priced advisor to reach your financial goals. You need a plan, the right funds, and the patience to let the process work. If you found this deep dive into the three-fund strategy helpful and you're ready to start simplifying your path to wealth, please take a moment to subscribe to the channel. We are dedicated to bringing you high-level financial education that cuts through the noise. If this video helped clarify your investing strategy, leave a comment below saying, "This was very helpful," and let us know which of the three funds you're focusing on right now. Also, make sure to click that thumbs up button to like the video, as it helps us reach more people who are looking for honest, actionable financial guidance. The information provided in this video is for educational and informational purposes only and should not be considered financial, legal, or tax advice. Investing involves risk, including the possible loss of principal. Always perform your own due diligence or consult with a qualified financial professional before making any investment decisions. Past performance is not indicative of future results. I am not a financial advisor, and the strategies discussed are based on general market principles that may not be suitable for everyone's unique financial situation.